Hey everyone, this is Logan Hertz with Hazeltine LLC. We are on part 10 of financial malpractice. I will be going solo today. I unfortunately will not be joined by Peter Nelson, but I thought we'd go a little bit further into this case study that we've been looking at. And just to reiterate, we have a 75-year-old whose financial advisor has basically kept all of his money in the market with no plan to withdraw it ever. And partly as a result of that, he ended up speaking with me. I introduced him to the infinite banking concept and some other potential alternative strategies that I think would be better suited for someone, really for anyone, but particularly for someone at his age. And his financial advisor, basically is fighting everything. And we're using this as an opportunity to provide some education on what could be some alternative strategies. And so, again, this is for informational purposes. Nothing in here is investment, legal, or tax advice. And we're going to go into a bit of what we've been talking about so far. And this is just reiterating this 75-year-old's current position. And again, his financial advisor sees no problem with this particular position. He has pretty much all of his money in the market, and there is no plan to withdraw it. There is no written plan of any kind. It's really just put all of your money in the market and hope for the best possible return on investment. And we've spoken a lot about why that's maybe not the best strategy for anyone, but particularly at this age, shouldn't we be de-risking, right? And when they say the market, quote unquote, they really mean the S&P 500. They really mean equities. Because there are multiple markets, right? I was thinking about this. I mean, there are lots of different markets you could be out there. They talk about the market, like there's this one market out there, in order to get us myopically focused on the one sliver of the Earth's financial markets that Wall Street can actually control, manipulate, the S&P 500. There are lots of other markets out there. Like they say, there's always a bull market somewhere. So when they say, quote unquote, the market is crashing, they mean the S&P 500 is crashing. But I guarantee you, if the S&P 500 is crashing, there's some other market out there that's actually doing well. And maybe vice versa as well. Like when they say the market, quote unquote, is doing well, they mean the S&P 500 is going up at a certain rate. Okay. So I try to use my words a little more precisely, right? When you go to your local farmer's market, that's a market. The S&P 500, well, it's a metric. I mean, it is a metric, and it is meaningful in some ways, but there's not just one market. There's not just one place to put your money. There's not just one way to invest your money. And we have to distinguish saving from investing from speculating. Those are three different kinds of activities, okay? Putting your money in a 401k is not saving. That is not a safe vehicle, right? And when you purchase an investment pays you. Cash flowing real estate pays you every month. You start a business, that pays you every month. When you put your money into a vehicle and you're hoping for capital gains, that is speculating. And there's nothing wrong with speculating. You can make a lot of money speculating. Just understand the difference and understand the risk you're taking on and position size appropriately. So here, by the way, we've done way more work on this case than his financial advisor has done. We're actually putting together a written plan, and we haven't even necessarily gone into all of the details, but this I think is very instructive. So again, summarizing his present position and the problems, right? He has all of his assets exposed to market risk, and they're generating no income, right? Especially once you reach retirement, or just even in general, I think. It's not so much about building up a nest egg. It's about how much income can you generate, right? So when you're in your working years and you have active income, you're trying to generate as much active income as you possibly can through your job, through your business, through a side hustle, right? Anything you possibly can. And then eventually you build up real investments to the point that you now have enough passive income that you can live off of. And at that point, you become financially free and you can retire if you want to. Okay. So having a nice nest egg is nice, but really what matters is how much income can you get out of it, right? And then of course he has his home, his house is his best asset, right? His paid off house, and it's not being utilized, right? So let's see if we can make use of that. And then of course he has no plan for long-term care and no death benefit protection. And the client did express to me a concern about long-term care. As Tom Hegna says, if you don't have a long-term care plan, you don't have a retirement plan. His financial advisor is claiming that having money in the market is somehow a substitute for a long-term care insurance policy. Okay, that's like saying having money in the market is a substitute for a homeowner's insurance policy, right? Build up a big nest egg, and then if something happens to your home, you'll have money you can tap into, right? And Garrett Gunderson talks a little bit about this, how, yeah, that gives you no leverage, right? If you pay $1 to get $1 worth of insurance coverage, that's not a very efficient use of your capital. So if you have $500,000 saved up and you're going to use that as your long-term care plan, well, you have only $500,000 worth of long-term care coverage, right? Whereas if you purchase a long-term care insurance policy or a whole life policy with a long-term care rider or an annuity-based solution, which what happens now is every dollar is purchasing multiple dollars worth of coverage, right? That's an efficient use of your capital. So this, I think, is a good summary of his current position, which we've been over. I just wanted to reiterate it. And now let's go a little bit into what could be an alternative strategy that we might propose. What does a real planning process, a real solution look like? Okay, and actually, before we even go into this, some of which we've already covered, I'm just actually going to be honing the plan a little bit more. I just wanted to revisit one thing that the financial advisor said in his email, where he talks about how money in the market and how we're expecting, in his words, average annualized returns of between 5 and 7%. Okay, and I also mentioned how he was being dishonest because that's what he put in the email, but that's not what he told the client. What he told the client verbally was basically double-digit returns that he was promising him, but he's not going to put that in writing. So he's being dishonest. But the other thing I thought about too, as I was thinking about this case more, notice, ironically, I've put a lot more thought into this case than his actual financial advisor has, and a lot more work into it as well. Partly because I feel so strongly about the way this has been handled. But if you're really going to expect average annual returns of 5 to 7% in the market, why don't you just put that money in a savings account? I mean, right now, there are CDs out there that are paying 6%. There are money market accounts and savings account where you can get 5% plus. So why would you gamble in the market and take on all that risk when you can get a similar rate of return in just a plain Jane savings account, right? And then you could even compare that to whole life, right? If you're going to go on and take risk in quote unquote the market, the S&P 500, and you're expecting, or your overall portfolio, and you expect average annualized returns of 5 to 7%, well, whole life, the return, then it's not about return on investment in whole life, but still, the returns you're going to get there would be competitive with that, and they'll be tax-free in a whole life policy. So if that's really your expectation, then why not just move your money from a risky asset to a risk-free asset where you can get pretty much the same return with additional benefits, with that death benefit protection, with long-term care protection, with tax benefits, etc. Okay. So if that's really the return you're expecting, then I think whole life looks really good by comparison, even from a return on investment perspective, which again is not the metric. Okay, so what are we doing here, right? We're going to eliminate risk, which for a 75-year-old is pretty important. You don't want to be taking on this level of risk. And by the way, I also reject the premise that you have to take on more risk to get greater rewards. If anything, it's the opposite of that, okay? We want to generate passive income, and we want to build a cash reserve, right? So today, right, this helps with his problems, right? Because today all of his money is at risk in the market. So we're going to eliminate, or at least reduce, the risk level. His assets are giving him no passive income. Okay, so we're going to generate passive income. And we're going to create the cash reserve that he doesn't have today. He really doesn't have much of a cash position today. So we're going to give him all of that. Okay. Now, how are we going to do that? All right. Well, let's look at it. Okay. So I've just got this little key here. You can see I'm indicating assets that are at risk versus assets that are guaranteed. So again, just to reiterate today, he has $565,000 in a brokerage account, and he has $109,000 in some other assets, most of which are still at risk in the market. There's an IRA, there is some cash, and some others as well. Okay, so all of that money is at risk, and it's generating no income. So the first thing we're going to do is we're going to convert these at-risk liquid assets to an annuity, which will generate guaranteed income for life. Then we're going to run this guaranteed income stream through our own private banking system, namely specially designed whole life insurance policies rather than a commercial bank. And that's going to give us a host of benefits. And we're going to use a reverse mortgage as our cash reserve, and it can potentially generate income in the future as well. Okay, so let's look at this. So step one, we are going to take this $674,000 roughly that he has, which is the vast majority of it is at risk, and we're going to purchase a joint life annuity, which has a guaranteed return on principal. So we have taken all of that money and removed the risk. Now I just add, I'm simplifying here, right? We might not just do this in one simple step, but for the purposes of illustration, I'm just assuming we would basically liquidate everything and roll it over into a joint life annuity. In practice, we might do it a little differently, okay? But this is basically the move, okay? So we've moved from having all of our money at risk in the market to having all of it guaranteed where we cannot lose and giving us income, a guaranteed lifetime income stream that both the client and his wife cannot outlive, okay? So this annuity would yield $59,000 in annual income, and that is guaranteed. Okay, that is the equivalent of an 8.78% return. So basically, we're getting a guaranteed 8.78% interest on that annuity, which we are collecting in income. Okay, so now we've removed market risk, we have a guaranteed asset, and we're getting income, which is what's so important once you reach this age. Okay, and that is guaranteed for the life of both him and his wife. Okay, and they cannot lose the principal. If for some reason they don't get all their money back in an income stream before both of them die, then the remainder is returned to their estate. So they cannot lose the principal. So we've removed risk and generated passive income. In addition, he still has his $60,000 of active income, and then they're going to be collecting Social Security, which I've not included. I'm not sure how much they're going to be collecting, he and his wife. But notice how I'm breaking this down differently. I'm not giving you, here's the size of your nest egg, because that, it's nice to have a nest egg, but what's really important is not what's the size of your nest egg, but how much income are you generating from it, okay? So he had $60,000 of active income. Now notice what we've done. We've doubled his income while removing market risk and getting guarantees, right? So that all of a sudden makes a big difference, okay? That money was locked up in jail and it was all at risk. It was basically not impacting his lifestyle, okay? And he was afraid to touch it for good reason, okay? Now we've annuitized it, okay? So step two. Now we're going to take this guaranteed income stream, and instead of depositing it into a commercial bank, we're going to deposit it into our private banking system, meaning we're going to take it and pay premiums into our whole life policy. Okay, so remember the financial advisor was questioning, I don't know how you're going to fund this whole life policy. Well, here's how. First of all, if we were really getting the double-digit returns that the financial advisor was promising, then there should be no problem, because that brokerage account would have enough gains in it every year such that we could just take the gains and put it into the whole life policy. But what we've done here is we've guaranteed that we can pay those premiums. Okay, so the premiums on the survivorship whole life policy, which again was just an example, maybe not a final solution, were $50,000 a year. So here we're getting a $59,000 annual income stream, which is guaranteed for the life of both him and his wife. Okay, we can take $50,000 of that every year and pay the premiums on this whole life policy. So there is no problem funding the policy, right? Notice how this is a great overall comprehensive solution where all the pieces work together. Okay, so we're going to take that income, and instead of depositing it into Wells Fargo and letting Wells Fargo profit from providing us with banking services, we're going to deposit it into our own private bank. Okay, and this is a survivorship whole life policy, which has a starting death benefit of $617,000. That death benefit grows with every premium payment we make, and we can use that death benefit for long-term care protection as well. And of course, every time we pay a premium, it grows cash value, similar to the way when you deposit money in a bank, you have an account balance. Okay, so we're not going to go into the details of that here, but that's how that works. Okay, and then we're going to live off of the $60,000 of active income, right? So that's what we're going to use to pay our expenses. Okay, and then the third thing is the reverse mortgage. So taking out a reverse mortgage on your house yields a $212,000 line of credit, which will be our cash reserve. And that line of credit grows over time. And they can use that money tax-free without paying it back as long as they're alive and living in that house. Okay, it is a non-recourse loan. So they could use all of that money and not pay it back while they're alive. And that line of credit grows. I believe it's currently growing at 9%, but it grows every year no matter what happens to the value of the house. So it is not just a cash reserve, it's a growing cash reserve, and there are no taxes due on the growth of that cash reserve. There are no taxes when we utilize it either. Okay. Similarly, with all the money in the whole life policy, that all grows tax-free as well and can be utilized tax-free because it's within the vehicle of life insurance. And because with both the whole life policy and the reverse mortgage, we're never actually realizing any gains or taking any actual income. We're just strategically borrowing against the asset. His active income obviously would be taxable, but he's in a pretty low tax bracket. The annuity does have some tax advantages, but it is not tax-free. So that annuity would start off being mostly tax-free because it's considered a return of principal, and only the interest, the 8.78% interest, is taxed. But again, you can see here, this is a good comprehensive plan that solves so many of his problems. Now we've de-risked you, right? We've got guaranteed income for life. Okay, we're reclaiming the banking function for ourselves. We have death benefit protection. We have long-term care protection, both of those through the whole life policy. And we now have a growing cash reserve, which can also generate income in the future. So this is what an actual financial plan might look like. It's not put all your money in quote unquote the market and leave it there forever and hope for the best. No, we're getting guarantees here, and we're reclaiming control of these financial elements, and we're getting income. And just one of the themes that I think came up too is that we are moving from market-based to mortality-based. So most of the assets that this financial advisor, in fact, really all of the assets that this financial advisor is talking about, are market-based. Okay, what's the problem with quote-unquote market-based? And again, when we say market, they're talking basically about the stock market. Okay, well, the problem is time doesn't work in your favor. Okay, if you are young, at least this would be the theory. I don't know that I agree with it, but in theory, right, if you're young, time works in your favor, right? You invest money today, hopefully that money earns for you over a long period of time. And so the longer the time period you have, the better it will look, and the more you can weather storms, right? Because you can afford to wait for the market to recover after it invariably crashes or goes down from time to time, okay? So market-based assets, I would say it's an accumulation strategy, and it's probably better for people who are younger, okay? As you age, you need to be moving out of market-based assets because time is no longer working in your favor, right? The sequence of returns risk oftentimes is what this is referred to, among other things, okay? Just the time value of money also. But there's a whole other class of assets that a lot of people are not aware of, or only are aware of in caricature, that are what I would call mortality-based, where time actually works in your favor, where your advanced age actually is an advantage rather than a disadvantage, okay? An example of these would be an annuity. What is an annuity? An annuity is a lifelong guaranteed income stream. So now there are lots of different ways you can structure annuities, and I'm not an expert on annuities, but this is in general the idea. You take a lump sum that you're worried might run out. You want to live off of it, and you want to make sure it lasts forever. You give that to the insurance company, and they then guarantee you a certain income stream for the rest of your life. Okay, so if you're a young person, an annuity probably doesn't make a lot of sense, because if you're 20 years old and you give the insurance company a lump sum and they have to guarantee you an income stream for the rest of your life, you're probably going to live maybe another 60 years at least. So the income stream they can give you is going to be relatively small because you're a young person, okay? On the flip side, if you're like in this case a 75-year-old and you want to give them a lump sum of money, they can guarantee you a much higher income stream, right? Because you're closer to your mortality, okay? So an annuity is a good example of a mortality-based financial asset that works better as you age, right? Whole life is another one. This one I think probably does work better if you're younger, but it still works well if you're older because you have that leveraged death benefit, that permanent death benefit, and it gives you long-term care protection, right? So in this example, we're paying a $50,000 premium into that whole life policy, and we immediately have a permanent $600,000 death benefit, knowing that this client, is reaching his natural mortality sooner and could potentially have a long-term care event. So the whole life policy helps you with those. And then this is the HECM, which is the reverse mortgage. I think it's called home equity conversion mortgage, I think is what that stands for. And again, it's mortality based, right? What the loan is doing is it's allowing you to utilize the equity in your home without paying any of it back until you die. Okay, so the older you are, the more favorable the terms they can give you, because the sooner the bank is going to get paid back. All right, so you have to be at least 62 years old to even qualify for a reverse mortgage. Okay, so again, this is just one of the themes that I was thinking about that came out of this case, that as you age, if you have market-based assets, you want to move strategically from market-based assets, where time is no longer working in your favor, to mortality-based assets, where your advanced age actually does work in your favor. And then lastly, just a little bit of a projection here. We actually had gone through a detailed projection, but this is just what this might look like as an example 10 years from now. Okay, so keep in mind we're taking on no market risk. Okay, so there's no market risk associated with these projections. This happens independent of whatever the S&P 500 is doing. So I'm not assuming the S&P 500 goes up at a certain rate, right? When you look at projections of market-based assets, it's all, in my opinion, very questionable, because they have to make an assumption about what the S&P 500 is going to do, and nobody knows what that's going to do. Okay, whereas here, all of these assets are guaranteed. Okay, so we don't have to make any assumption about what quote-unquote the market is doing. So there's no market risk, and on the whole life policy and the reverse mortgage, there are no taxes due. Okay, this is all tax-free. Gains you make in a market-based account obviously are taxable. The only thing here that is taxable is the $59,000 annual income stream coming from the annuity, which, as I mentioned before, still has some tax advantages. You're only taxed on what's considered the interest that you're being paid, not the principal. So the interest rate technically is 8.78% here. So, and I also want to point out, with the whole life policy and with the reverse mortgage, okay, these are two-dimensional assets. You cannot look at the reverse mortgage or the whole life policy and look at how much cash do I have available to me and think that's giving you the full picture. It is not. Okay, that's like looking at a piece of cash flowing real estate and just looking at the total value of the property and how does that go up over time. Well, that doesn't give you the full picture of all the benefits that the real estate investor is realizing from that asset because of all the ways that he can leverage it. Okay, so the point that I'm making is you can utilize all of the cash that's available to you in your whole life policy or your reverse mortgage without interrupting the growth in the asset. So your whole life policy's cash value and death benefit keep growing, even while you're strategically using the money via policy loans. As you pull money from that reverse mortgage line of credit, the value of your reverse mortgage, the value of that line of credit keeps growing. Even if your house crashes in value, by the way, that reverse mortgage line of credit is not affected by market risk. Okay, so it keeps growing, right? So that's important to understand. So the numbers here cannot fully express the benefits you're getting, not to mention the death benefit protection and the long-term care protection you're getting from this survivorship whole life policy. Okay, but just as a projection, 10 years from now, the death benefit on that whole life policy will have grown to over $1 million. Of that, you can use $968,000 for long-term care protection because you can advance to yourself almost all of that death benefit should you have some form of long-term care need. You will have over $528,000, $528,000 in cash value. You have the policy loan feature, which is guaranteed. There's no credit check, there's no debt, there's no repayment terms. It is not at all like borrowing against a market asset where you have to go through a credit check. The terms are set by the bank, and you're putting your whole portfolio at risk. Here, none of that's the case. You take out a policy loan, it's a guaranteed contractual right that you have because it's your money, and you never have to pay it back as long as you live. And then what happens is when you die, the death benefit pays off any outstanding policy loan. And of course, legacy planning, right? Oftentimes people have money and they're afraid to spend it as they age because they want to leave something for the children. They want to leave something for the grandchildren, right? Well, you don't have to worry about that because in this case, you have $528,000 of cash value. Let's say you used all of it, okay? Well, you still have $1 million death benefit. So if you borrowed out that full $500,000 and spent it, then when you die, your heirs would still get that $1 million death benefit minus the $500,000 that you borrowed out. So your heirs would still get $500,000, right? So you don't have to be afraid to spend the money. That's another one of the beauties of having a permanent death benefit when you're in retirement, is it gives you a permission slip to more freely spend the assets that you do have, knowing you've already taken care of your legacy planning. You don't have to worry about what you're going to leave for your family. And the reverse mortgage has grown to over a $436,000 line of credit. And of course, if you use it, there are no required payments. And the value of your house keeps going up. The line of credit keeps growing in value also. Okay. All of these are completely tax-free. The whole life policy and the reverse mortgage, all of these benefits are tax-free. Okay. And oh, by the way, you're still collecting income from that annuity. That annuity is guaranteed to continue as long as you or your wife are still alive. Okay. We could also even add some more potential long-term care protection. Peter Nelson brought this up, what he called a GLWD, a guaranteed lifetime withdrawal benefit, which means basically, let's say you had some form of long-term care event, then that annuity income stream would double from $59,000 to $118,000 as long as you had the long-term care need, right? So it will provide you with additional income to address that potential long-term care need. Now that's not illustrated here. This is just a joint life annuity. We do not have the GLWB on it, but that's something we could potentially do. Again, while I've gone into a lot of details, I haven't gone as deep as I normally would with case design. And again, not included here, they would be collecting some Social Security, potentially There might also be active income as well. But this is just, again, showing a projection 10 years out. So that was it for this video. I hope this was helpful, and I hope this gives people a lot of things to chew on, and shows you, I think, what a real, actual financial plan might look like.